Welcome back. You're watching Citizen Business, and as we did say at the beginning, we are stargazing into 2016, and I'd like to introduce my panel, our distinguished panel who's joined us this evening. Dr. James Mwangi, Group CEO, Equity Group. He's also the chairman of Kenya Vision 2030 Delivery Board. He's a member of the Africa Leadership Academy South Africa, alumnus of University of Nairobi and Strathmore Business School. Mwangi is a certified public accountant, holder of 4 honorary doctorate degrees, affectionately named as King James. However, when I asked him earlier, he said he's never heard of it. So I will assume you were being modest. Dr. Laila Macharia, Vice Chairperson, Kenya Private Sector Alliance, founder and CEO as well of Sion Real Estate. Non-executive director, Barclays Bank of Kenya, as well as Centum Investment, holder of a doctorate degree in law from Stanford, and alumnus of Cornell Law. And Dr. Macharia is also an advocate of the High Court of Kenya. Thank you so much for joining us tonight. We've got Joshua Oigara, CEO, KCB Group, Chairman, Kenya Bankers Association as well, and we'll be looking for some responses in regards to what's happening in the banking sector going forward. Previously worked at Bamburi Cement and Bidco Africa, studied at the University of Nairobi and Edith Cowan, University of Australia, and Oigara is a certified public accountant. Thank you so much for being on the Business Center tonight. And Zetsewere, development economist. Of course, you've been on the show quite some time, and we love to have you here. And Zetse is a researcher and a writer, weekly columnist at the Business Daily. She studied at the University of Sydney and has previously worked at the Aga Khan University. Of course, she is our economist on the show tonight. Now, at this time last year, investor expectations were high in view of efforts by the government to improve the country's business environment, with particular focus on boosting security, transport, infrastructure and energy. However, 2015 was a bumpy ride for the business community as the shilling's depreciation to the US dollar sent up the cost of inputs. Borrowers too had to face higher lending rates. As Bella Genga now tells us, investors remain optimistic of the country's economic performance even as the campaign period begins.
The government projected that Kenya's economy would grow by nearly 7% in 2015 based on improved business conditions. But as the year wore on, the economy went on to face a volatile period that began with the weakening of the Kenya shilling, forcing the central bank to signal an interest rate hike.
The challenge with last year was the volatility. Within 3 to 4 weeks it spikes by more than even 10%, then all of a sudden it comes down. It makes it very harder to plan, introduces uncertainty in the economy, and that's what investors don't like.
The downturn in tourist arrivals to Kenya, a key source of hard currency, exacerbated the situation as the country's foreign currency inflows lagged behind its growing import bill. What are the key determinants that will shape Kenya's economy this year in 2016?
Security situation is much better in 2016 than it was in 2015. Interest rates are under control. We still expect them to go high. Inflation has started to creep up, so that's a story that is going to be a little worse in 2016.
The government's borrowing appetite will remain a key driver of interest rates in coming months, as the government is yet to meet its domestic borrowing target of 219 billion shillings set out in June last year.
That means they will be in the market competing for money with the private sector, so we expect interest rates to go up and go up gradually. The exact amount of increment, it's hard to predict that because it depends. You say government can also decide to contain its borrowing in terms of funding.
In 2015, about 15 companies warned investors of lower full-year profits, up from 11 companies the previous year. It is expected that the tough streak will continue for corporates in 2016.
Overall, I think the consumer is going to be still under pressure in the course of 2016. We've seen interest rates remaining moderate to slightly high. That could put a bit of pressure on being able to spend.
On the brighter side, investors are positive about the falling global oil prices, which have so far tumbled by 40%.
Suddenly 2016 will be the year when we see the campaign season check in. So in your opinion, what are investors' approach this time around?
It's part of what we have to go through every 5 years for those of us who live here.
The 2016 economic journey does not seem as bumpy as it was in 2015, but investors are cautiously optimistic even as the political undertones become louder. Bella Genga, Citizen TV.
Thank you very much, Bella, for that. And we'll now quickly delve into our conversation. And I'd like us to start just by distinguishing where you stand in as much as your predictions and hopes for 2016 lie. Let's start off with you, Dr. Mwangi.
I think 2016 is going to be one of Kenya's best year. One, while people really appreciate the challenges we went through in 2016, it demonstrates the resilience of the economy, particularly the resistance to external shock. The second aspect is that we are now coming to fruition of maturity of the Vision 2030 projects, whether it is energy, whether it's airports, whether it's ports, whether it's roads and railways. Now the benefits of all these investments will now start being harvested by Kenyans. And I think the last one is the reforms that the country has gone through. The reason why we could only have a small spike in currency and was well predicted was that the economy has gone through reforms that has made it strong and resilient. The economy has also become significantly diversified, and people are underestimating. And lastly, the economy has reached a level that it can now be a global player, particularly in the capital flows, in the capital markets, and it's not dependent like it used to be in the past on donor funding. For instance, we are saying, and there is a speculation, that 2016 will be very difficult because of 2017 election. My prediction is that the economy is slowly divorcing itself from our politics.
All right. And sorry to cut you off short, Dr. Mwangi, but we will come back to politics, which of course is one of the biggest fears for some of the investors this year. Do you share, Laila, in Dr. Mwangi's optimism?
Yes, absolutely. I think we're not naive. We're not saying that there are no problems or there are no challenges. We're on the path where we have been reforming our economy consistently. The business community has been very engaged in this reform process, and we have seen a lot of maturity and sophistication growing into our private sector, not just in the way that we engage government, but even in the way that we're making sure that our enterprises are sustainable and scalable. We're seeing a big emphasis on entrepreneurship coming out of KEPSA and other parts. So government really recognizing the importance of entrepreneurs, not just startups, but even how do you make sure that these job creators are scaled up. So we're very optimistic that this year we'll see a lot of the reputation that we hear about Kenyans being innovative, about the way that the technology is being infused across all sectors of the economy coming to fruition. In addition to that, as Dr. Mwangi has said, a lot of the investments we've made, for example, the very ambitious energy investment that we've made in this country, we're seeing a lot of geothermal coming online. We're being noted all over the world for our wind power. There's coal. There's a quite diversified portfolio of energy projects coming online. We're going to be seeing the fruits of that coming in and other infrastructure developments. So overall, we're seeing that it's all coming together. This is always inherently a long-term project. And that's how we approach it as the private sector advocating for change. But we are seeing that over time it's more of a marathon than a sprint, but we're seeing some progress.
All right, Joshua, your thoughts about 2016?
Yeah, I would say, Sherry, that we're quite positive as an economy overall. I think this year is going to be quite a strong year than what you've seen before. A lot of heavy lifting has actually been done in the last year. And I would say just two aspects to add. One aspect to look at is building an economy is a more long-term race. And I think we tend to look at short sprints and assume that the sum of short sprints is a long-term for the economy. It's actually not true. So if you look at our performance overall, even last year, Kenya performs one of the best in terms of its own neighbors. If you look at its own neighborhood, whether it's within the region, we operate across many countries in the region, which are comparators. If you look at our central bank, we are a very strong governor today looking beyond the curve, actually in terms of macroeconomic policy. So even going beyond, and then we've also benefited from a lower cost of oil. So yes, we say that there's some rise in rates, but obviously, looking at the basket of the economy, in my view, Kenya is demonstrating what is possible for an African economy on a global scene. And so this year coming up, Tyrian, is for us to harvest the huge investment made in the last few years.
And some still say that even as crude oil prices internationally continue to fall, we're not yet, as Kenyans, benefiting completely, from the performance of oil prices abroad. But we'll come back to externalities and what that means for Kenya in 2016. And Zetsa, you have been very critical, of how the government is managing itself from a fiscal point of view, the whole corruption debate. What are your expectations for 2016?
I think it's measured optimism, but I think we need to understand that there are both opportunities that need to be leveraged, but threats that have to be managed. As a macroeconomist, the three big issues that I see are inflation, We have now gone above the upper limit that government prefers to stay under, which is 7.5%. Last month we hit 8%. And the reason why inflation is important is because one of the monetary policy tools that is often used to rein in inflation is raising rates, right? So we need to be careful around managing inflation but keeping borrowing affordable. And when you look at the rates issue, the interest rate issue also, we're in a very interesting space, because on one hand, you know, there's pressure to lower rates and, you know, help, you know, fuel economic growth. But the reality is that domestically, I don't see government reducing borrowing in domestic markets, and we know that generally tends to signal upward pressure for interest rates. But even if you look at international markets, one of the things we're seeing is that as the U.S. economy is recovering, borrowing is becoming more expensive for emerging and developing economies. So even if government does seek to borrow in international markets, they will have to reckon with more expensive borrowing. And then, of course, the whole issue around Eurobond management corruption did negatively inform global investor confidence in Kenya as a fiscally responsible economy. So I think we still will see Kenya getting into more expensive borrowing because of those factors. And then, as you mentioned, the political intensification of activities has always been correlated with muting growth. So I think we need to really start demanding as Kenyans that there is more responsibility and accountability in terms of articulation in the political space, so that these negative ramifications are minimized. But there are positive things in terms of ease of doing business. We went up 21 positions as Kenya, so there is a recognition that the reforms that have been articulated here, we're really beginning to start seeing that they are feeding into investor perception of Kenya as an investor destination.
All right, you've raised the interest rate issue, and we've got the two perfect gentlemen here who can lend us their ear into that particular issue. Of course, last year, quite a tough time for most borrowers. In such a short span of time, interest rates went up by almost 10% for most consumers. And James, you did mention last year perhaps one of the most profound statements for us as people who borrow from banks, and you said, do not borrow now. Is it a good time to borrow?
Oh, it's certainly. Interest rates revamped back to where they used to be. The central bank, which really had used interest rates as a tool of managing the volatility of the economy, reversed it fully. And essentially then the interest rates also reverted back to where they were. So it is time for Kenyans to invest.
Oigara, what are your thoughts about interest rates in 2016, given what Anzese did mention earlier, that if the government goes back to borrow locally, then we as consumers are in trouble again?
I mean, I would say, Terry, that it's not the first time that we've seen. I mean, the government has got its own expenditure plan for the year, and they're able to raise taxation. I mean, that's the reality of the matter. I think the real issue for me has been that it's more the tools that the central bank has used to be able to manage the macroeconomic aspect that have actually responded to interest rate increase, and not the increase in government expenditure. And so there is a geo-balancing between what's happening on the fiscal side, on the monetary side of the economy. And remember, at the end of the day, the budget has been presented before Parliament. That has already been approved. And so what we are seeing now, the rates have come back back where they were. And we should expect, ideally, because banks operate within a real economy, that if there's a tightening instance, we need to be able to respond to take up the rates. And that manages all aspects of the economic framework. And then when the rates fall off, the banks have actually passed the benefit. So we've seen increase in lending now, you know, from the last quarter, from December and January for the last few days, which shows for me that, you know, that is coming back off. All
right. One of the questions we're getting on social media, a line that's 22422, is a number of people saying, especially now that Oigara and Mwangi are here, please ask them, why is it that when rates go up, the banks immediately increase them, and why, when they go down, it takes quite a while to come down?
Thank you. It's a very nice question. What happens is that, as we said, mostly, particularly last year, the interest rates were being driven by government action to manage the economy. So as they trigger, what happens is instantly you have the price for all deposits, because people are given alternative. But banks lock deposit for 3 months or 6 months. So as the interest rate starts coming down, the matching period is normally 3 months to 6 months, because already the banks have already booked the money. But when it is rising, it is set by as today's price, and everybody demands the present price. But when it's coming down, it is contracts that you have to unwind, and that's why there is always that delayed. But normally it lasts 3 months at most.
All right. We want to take a short break and then we'll come back with more. But just before we do that, amid the cautious optimism around Kenya's general economic environment, general lending rates since November 2015 remain unchanged. Taking a look at the personal loan rates offered by some of the country's biggest commercial banks, we start with James Mwangi's Equity Bank. The lending rate on secured personal loans is at 21% and at 24% on unsecured personal loans. Oigara's KCB has pegged its lending rates on secured personal loans at 20% and at between 21 and 24 on unsecured loans. Cope Bank has its lending rate on secured personal loans at 20% and 24% on unsecured, while Barclays Bank is at 18.5% on secured and 20.5% on unsecured. Standard Chartered 21.5% on secured loans and at 22.5% on unsecured personal loans. And finally, let's have a look at Family Bank, which stands at 22% on secured loans and at 24% on unsecured personal loans. Now, these are the current rates according to the respective credit officers in the selected bank branches and call centers that we talked to earlier today. Watching the Business Center, and we are having a conversation about Kenya's economy in 2016 and how what happened in 2015 in terms of the headwinds then will impact this year. Let's kick off with the pessimism in the global markets. And Dr. Mwangi, when we spoke last year, towards the end of the year, you did say, you know, Kenya is part of the global economy, and whether we like it or not, if there is a shake-up internationally, then it will hurt us as well. So we're seeing a contracting economy perhaps in the U.S. this year, according to global economists. We're seeing China continuing to contract as well. Are we insulated as a country from these externalities?
I think, as we earlier said, the transmission of global shocks goes through capital markets, they go through international trade and prices of commodities, and then they go through geopolitics. And when you look at the current drivers, and let's talk about China, it's purely a commodity issue. Kenya doesn't have any of those commodities. So to that extent, we can say it's insulated. Let's go to the US and talk about the increasing interest rates. Kenya is not insulated because 70% of us trading at the stock exchange is capital, is global capital. That global capital will react to the interest rate regimes. So essentially that, let's look at commodities. Again, if you look at commodities, Kenya at the moment is reaping the benefits of that shock. Instead of being adversely affected, oil is 60% down in cost. Oil constitutes over 25% of our import bill. So essentially, we are getting a discount of 40% on what it costs us to maintain the economy from one commodity. If you look at our export commodities, coffee, tea has moved from a price of $1.8 to 3.2. Essentially, our commodities are behaving on the other way, increasing, and that is why we are seeing the import bill is coming down and the export earnings are increasing, and essentially that position Kenya very, very well. So I would say at the moment we seem to be balancing. The forces seems to be balancing as in favor of Kenya, and that is why we should take advantage of this situation to then invest, such that that 60% saving is not wasted. We can build railways, we can build airports, because it's a window that might last 3 years. It has already lasted 1 year. If it takes another 2 years, then we'll say, yeah, the discount we got or the savings we got, we applied it in this for our children, not for ourselves. We don't consume that money. All
right. And of course, growth in exports is one of the things that they say our economy badly needs in order to move up to middle level by, is it 2020? Maybe you can tell us about what you think about the industrial plan and how that will impact growth in 2016.
Yes, I mean, we've talked a bit about the external shocks and some of the reasons why we have this imbalance between exports and imports. But fundamentally, we have an issue in Kenya and in many African countries where our share of manufacturing as a percentage of GDP has has flatlined for decades now, at about 10%. We've got to do something about this. We have to increase our manufacturing base, especially manufacturing for export. We do have some areas in which we have strengths, things like agribusiness, where we could be value adding and doing more export. And the new industrialization plan is really looking at that, has identified very strategic sectors where we have a comparative advantage and where we can call them low-hanging fruit, where if we make some targeted investments, we can see some return. These include things like cotton, getting back our textile industry up and running again. We know we produce a lot of fish, but it's processed offshore by other entities and other countries. We can get a processing facility at the coast. And of course, all our, you know, we have a comparative advantage on horticulture and cut flowers, in addition to other agribusiness, you know, cut vegetables and the like. And we want to see, is there a way we can deepen that strength that we have? So the industrial plan has now come out, and we are looking at how we can put targeted facilities, special economic zones, where we start really raising that share of our GDP. A very, very important. And the Kenya Association of Manufacturers, very dedicated and working with industry to see this become a reality, and us all very supportive with that. It will create jobs, and it will also start creating balance so that our imports are not as high as they look now.
And so let's look at Kenya and Ethiopia. And I know that you've called Kenya the laggards in the economy in terms of growth and in terms of comparing us with other economies in the region. Economies of Ethiopia growing at about 10%. We're slowing down and haven't been at 7% for perhaps the last 3 or 4 years. What are your thoughts now about where Kenya stands and where Ethiopia is? And the reason I'm asking that is because I know Joshua has very strong convictions that we should not even be comparing Kenya to an economy such as Ethiopia. But perhaps you can tell us what you think.
I think the interesting conversation around Kenya and Ethiopia is really the tension between democracy and development. And I think until we as Kenyans reach a situation, and perhaps we're beginning to go there now, but really the fundamental problem is that when you have a young democracy and a young economy, they tend to be at loggerheads with each other sometimes, and often political issues, which is why the political issue is so important when people are talking about Kenya. Often political issues will have economic ramifications. The reason why Ethiopia becomes used for juxtaposition is because they have a very different political system going on there. And often the perception is that there's a more stable political system through which more long-term solid investments can be made. So for me, really, the issue that I have is, can we start finding ways, particularly as stakeholders in the Kenyan economy, government, private sector, non-state actors, etc., how can we start separating the economy from politics? Because really that's what we need to do, is to have long-term economic plans, long-term economic growth. And right now the current nature of political, I would say bickering, quite frankly, and sort of also the way media portrays Kenya politically, internationally, I think is another problem. And I think for me the emphasis really should be, we need to start doing some of the things that Laila is talking about, industrialization policies, how do we build our export profile, how do we diversify, things like that, so that now becomes less of an issue. So for me, that's the emphasis.
And of course, that raises the issue of benevolent dictators and whether Africa needs a lot more of those. Joshua, your thoughts about Kenya's growth vis-a-vis the region, and the discussion we had earlier, and James Mwangi said Kenya grew faster than Australia or Canada or some of those countries that we would never think of when we think of Kenya's growth.
Terry, and I would say, in my view, that you're going to look at how do you really compare. Sometimes are we comparing like to like many times. I feel that last year was a very strong year for our economy for Kenya. From all numbers seen, whether you look at it from an inflation perspective, currency perspective, expansion of economies, that's really good for us, especially in the region. And we set up a business in Ethiopia, look at Rwanda, Burundi, Kenya, Uganda, Tanzania, and within the DRC, you will find that the economy is actually, it's a catalytic economy. So you're going to realize the economy is pushing a new frontier. And in that environment, we delivered a strong growth beyond 5%. Now, we just opened up in Ethiopia, and it is a small economy that is coming up. It's a smaller economy than we have. And therefore, the challenge is to look at what opportunity do we have. I look at many sectors. Agriculture. This year we look at smaller businesses coming up, increasing exports, getting more opportunities. Look at tourism. Now, this year we're seeing huge upsides in the way we want to be able to build on local tourism. I mean, if you look at Mombasa in the last quarter and now, it's largely 80–90% are local tourists. And now we're seeing international tourists coming in. If you look at energy sector, we've been able to see a reduction in our cost of our input materials. So these elements just show that you're riding next year, 2016, on a very good platform. And that's a must repeat for sure. Because sometimes we look more into, there's a lot of negativity that we always speak in our country and say the country is not growing. But I am a strong believer that the numbers, which is always say the truth, don't change. And so I want to say that the platform is very strong. Of course, are we going to grow on 10%? That is our aspirations. If you look at Ethiopia's growth in the last 10 years, they were highest 14% in 2010. So again, you're going to look at what has happened in the last 4 years. But I am extremely positive that across all sectors, look at telecommunication technology. Is a very big area of innovation that Kenya has done in our market and globally. And this is what gives me a big conviction myself. And when I speak to a lot of the younger people in our country, they are very convicted in driving the change and growth of our economy.
All right. And of course, the IMF did predict towards the end of last year that they expect 2016 to grow at about 6.8%. Of course, they trimmed it down from 7.2%. But, you know, the common consensus is that economists are happy about that figure. Let's talk about entrepreneurship. You know, 2015 had a lot of emphasis on small and micro enterprises. There was a lot, you know, after the GES and that whole entrepreneurship spirit that keeps, you know, so resilient in our market space. Perhaps, Dr. Mwangi, you can tell us about entrepreneurship and how do you see that making an impact, not just for the country, but also for the thousands of people out there who are unemployed today?
I think entrepreneurship is very, very critical for development of economies. As we know, with technology taking the spin, public sector will continue to shrink in size and government will cease to be a major employer. So the private sector must be the engine of economic transformation. But more importantly is the ownership of the private sector. And entrepreneurship is our initiative to put the private sector in the hearts of the citizen, so that when we talk of creating wealth within the economy, it's wealth retained in the country. So I would say entrepreneurship is the face of our ownership and control of the economy. And it's very important that we continue to invest in this area. As we invest in this area, we take advantage of the expanding market. We are now talking of an East African economy. That means our market has gone beyond the 40 million people that we could have said we are setting in Kenya for 40 million people. We are now doing it for 130 million people. So that ability to expand is much, much bigger than the creation of employment within the economy. The second one is that it allows us now, entrepreneurs, to start processing. Entrepreneurship is the next step. We become primary producers, and then entrepreneurs pick the produce and process it, add value, and create employment. So that is the opportunity. Are we doing well? I would say Kenya stands out as the economy with great entrepreneurial skills and capability. And I have no doubt that is why we were chosen to become the first host of the global entrepreneurship summit in sub-Saharan Africa, in recognition of the Kenya's ability to leapfrog from that opportunity. When you look at the flow of capital at the moment, we find every day you read papers, 10 billion in this bank, 10 billion in this private equity. It's all again recognition that yes, we have the spirit, but we now need matching of funding, and that is coming slowly in place. Lastly is when you look at the growth of entrepreneurship, we now have between 20 and 30 companies that has now become regional multinationals with a home base in Kenya. That is the measure of our success.
All right, we're about to wind up, but I can't let us go before talking about the politics of 2016, the campaigns of 2016, the elections of 2017, and how that then impacts our economy. And Zetse, let's just kick off with you. Do you think, you know, the current political diatribe, so to speak, do you think the politicians care about where Kenya's economy is going?
I think there are a couple of things going on right now that we need to be aware of. One is sort of a traditional bickering, I think, in the political circles that I think needs to start being muted. And I think increasingly political leaders need to understand that they have an effect and essentially a responsibility to be responsible in how they articulate their concerns and their issues. Because what's happening is that our international perception out there, when we look at the headlines that we have, when we look at the TV coverage that we get, is that Kenya is a risky place. You know, the politics aren't good, you know, there's a lot of corruption, etc. So I think there needs to be a more conscious effort, because it's something that we can do. It's not an impossible problem. This is something that we can solve. So let's solve it, you know. Let us be a bit more responsible and insightful in our critiquing, you know, whether you're pro-government or against government, so that, you know, that meeting that, you know, politics tends to have on economic growth becomes less and less and less, and then we have a stable economy that is independent of political diatribe.
All right. Well, Gary, your thoughts on politics?
Yes,
and
Terry, and I would say just maybe two aspects on this, that ultimately all of us must believe that our efforts must contribute to building a better country. It doesn't matter where you belong. Not a guy from outside is going to come and build a better Kenya for ourselves. And what I've been very excited about is, you know, you have to appreciate the space, the democratic space that Kenya has compared to its neighbors. But as a business here and the private sector, we continue to invest no matter whether there's politics or not. We haven't stopped investing. We haven't stopped asking for customers to be able to do new projects. In fact, if you look at the last 10 years, we continue to do bigger businesses, bigger investments, despite this kind of... And in my view, I think it shows that the economy is becoming resilient. The private sector is taking the long-term shot on how the country can unfold. And that is the catalytic nature of our economy. So does it stop us making investment? I would say no. I mean, and we've been able to see that Kenya is very independent itself in terms of its own fundraising, its own partnerships. The concern we have is how we are seen globally by our partners. But just like yesterday and this year, we've seen international partners bring in capital into Kenya to invest in activities. That, for me, is what we need to do, is that we can perhaps grow faster if all of us were having the same conviction about building Kenya is our brand, is our country, and hand over a stronger country for our future generations.
All right. Laila, what is it that gives the private sector sleepless nights over elections and campaigns?
What we would like to see is a reduction in the noise, and I think part of what the panel is talking about is about a maturity, a political maturity. There's such a thing as constructive dissent. We're all trying to make Kenya better. We're not saying we're perfect, but the whole idea is to be a contributor to that progress, and to say here are our issues and be transparent in the way that you engage about them, but not to make it a slash and burn kind of approach to the way that you deal with politics. So that's what we'd want to see. I agree that all of us are very optimistic. We continue to invest. There's nobody who's pulling back. But what we would really find a sad and tragic thing is if we had that same kind of escalation where you have optimism, we're creating jobs for Kenyans, and then as 2017 comes, people start withdrawing, it's screeching to a halt, and we have this kind of shape in the way that we grow. We would like to see an increasing reduction of that kind of dynamic. It's very retrogressive, and it takes a lot of progress backwards. So yeah, that's something we'd like to see change.
All right, James, as we wind up, you mentioned that, you know, politics and the economy is beginning to have a smooth divorce, so to speak. Do tell us a little bit about that.
I strongly feel that the structure of the Kenyan economy is changing day by day. If you look 15 years ago, there was not even a single Kenyan bank that was in the top 10 banks. And consequently, every time there was elections, the banks froze ready. Economy was heavily donor funding driven. Funding was withdrawn. Today, our top largest banks are Kenyan banks. So they don't care whether they will be politics, will continue funding the project. So we are unlikely to see. The second one is that the entrepreneurship and capital, what we could call indigenous capital, is becoming significant, proportionate to the total capital in the economy. And that capital doesn't create freeze because there is politics. Politics is part of us. Lastly, let me say, we as Kenyans owe it to ourselves to create Brand Kenya. Politics is central, but politics is just one aspect of our lives. So when we allow politics to create Brand Kenya, then it means every other facet, economy, social lives, everything else about ourselves is ignored. So if Kenyans stood up and said, Kenya is a breed of everything about us, but Kenya is not equal to politics. Because then what happens is that politics provide policy and leadership, but opportunities are given by economy. So Kenyan economy and blood should be defined by that which is collectively shared by all of us, and that is economic opportunities.
All right, I've been given a few more minutes, about 2 of them, just to specifically ask about the opportunities that you see in Kenya for 2016. So if you were to put your money where your mouth is, Oigara, what would you be putting your money on in 2016?
It's quite exciting that across all sectors of the economy, whether it's service sector, whether it's tourism sector, agriculture, we see tremendous opportunity for 2016. I mean, there is concern around the money markets, but that's in my view that you see an upside. And therefore, this is a year to be able, I said earlier in my conversation that the heavy lifting has been done in 2015. This is the time to take advantage for the opportunities that we see for the businesses for 2016. So it's a time to go out there and take on and build on what you've been able to start on in 2015.
All right, and
I think the important thing is for particularly entrepreneurship to be structured in a manner that allows a reorientation of the economy that's more healthy. I think particularly building industry is very important, and I think preventing the premature deindustrialization that we're seeing in some African economies, we don't want to follow down that path. So I think we need to be a bit more deliberate in terms of how entrepreneurship informs our economic growth, so that we're making structural changes that are robust and lead to long-term growth.
All right, Laila?
The economy, because of our demographics, because of the place that we're situated, this neighborhood of Africa, there's so many sectors where one can get involved, from finance to education to health to agriculture. There's opportunities endless. I think where I would focus is actually looking at technology and also starting to look at companies that actually have some traction, and we're looking at scaling up. Those are the 2 areas that I would focus on. As KEPSA, we're very excited. Enterprise Kenya is being announced this year, which is going to be a national incubator accelerator going across the IT, starting with the IT sector but going into others, to start helping businesses that are fledgling start to move along that path, so that we can see many more multinationals that can be regional and even global in the decades to come.
All right.
I think logistics will become a very big industry because of the infrastructure that has been built. Logistics relies on infrastructure, and infrastructure is taking shape. I think the energy sector, and particularly manufacturing, we are likely to see affordable, reliable energy now going forward. So those who are in manufacturing, all huge energy-consuming industries, are likely to flourish. And lastly, the aggregate of all economic activities passes through banks. So we are likely to see good performance of the financial sector.
All right, and of course that will be something to watch, keeping in mind that about 16 of companies listed on the stock exchange have already sounded profit warnings. So we hope that there will be a turnaround, so to speak, in corporate earnings in 2016. Thank you so much for joining us on the show tonight. Dr. James Mwangi, Equity Bank CEO, Laila Macharia, Vice Chairperson, Kenya Private Sector Alliance, and Zetze Were, Development Economist, and Joshua Oigara, CEO, KCB Group. Thank you so much for being on the Business Center and for sharing your thoughts with Kenyans tonight. Thank you.